So, imagine a company. Sounds like it was plucked straight out of a spy thriller, a real giant working with really high stakes data, often behind the scenes. We're talking about Palantir Technologies, ticker PLTR. And it's a name that, well, it sparks really intense debate in the investing world. You got this undeniably powerful technology, right? A formidable market position. But then there's this huge tension, this core dilemma between those strengths, and it's truly head-spinning valuation.
Yeah, you've absolutely hit the nail on the head there. That's the central paradox.
Hmm.
So our mission today is really to clarify this complex issue for you. We're going to break down why Palantir is, both revered for its capabilities and at the same time seen as incredibly risky for investors.
Yeah.
Ultimately, we want to shed some light on what makes it such a challenging investment decision right now, give you a clear perspective, some actionable insights, and hopefully maybe an aha moment or two as we dig into the source material we've looked at.
Okay, yeah, let's unpack this. Palantir's origin story, it's pretty unique, almost cinematic, like you said. They started back in 2003, and their goal was very specific, helping U.S. intelligence agencies, in the fight against terrorism. That's not exactly your typical software startup, is it? How did that beginning shape where they are now?
No, it absolutely wasn't, and it fundamentally defines their core business, even today. That mission meant they had to develop these incredibly advanced software platforms, each one designed for very specific, very high-stakes applications. We're talking situations where data analysis is, well, literally a matter of national security.
Right. So tell us about them. I know Gotham is their big government platform. Yeah. What exactly does it do?
Yes, exactly. Palantir Gotham is their flagship. It's purpose-built for the government sector. Think defense, intelligence, law enforcement agencies. You can think of it as this unparalleled tool for finding patterns hidden deep inside massive, often disconnected data sets. It takes all sorts of stuff, signals, intelligence, field reports, you name it, and turns it into actionable insights for really mission-critical operations, counterterrorism, intelligence gathering, battlefield management, that sort of thing. It's been genuinely transformative for agencies like the CIA, the Department of Defense, really powerful stuff.
Okay, so Gotham's focused on national security, defense. What about the private sector? Do they have something comparable for businesses?
They do. That's where Palantir Foundry comes into play. It's designed specifically for commercial clients across a whole range of industries: finance, manufacturing, energy, healthcare. Its real genius, I think, lies in breaking down those data silos that plague most big organizations. You know the ones. Foundry creates this central, unified ecosystem, a place where a company can integrate, model, analyze all its data, all in one place. And the result, well, is huge efficiency gains and an incredibly powerful predictive analysis for complex business problems.
Okay, so if Gotham and Foundry are sort of the analytical brains, what's Apollo? I've heard that name too.
Ah, right. Apollo is kind of the unsung hero. It's the continuous delivery and infrastructure platform. It's the backbone for both Gotham and Foundry. It basically ensures these core platforms stay secure, stable, and are continuously updated. And that's regardless of where they're deployed. It could be public cloud, it could be on-prem servers, even highly classified networks or, remote devices out in the field. It handles all that complexity, ensuring reliability and security.
Got it. And what about their latest offering, the one getting a lot of buzz lately? The artificial intelligence platform AIP. That seems super relevant with the whole AI boom happening.
Oh, absolutely. AIP is pivotal. It's a very recent offering, and it directly taps into this massive demand for enterprise AI right now. What it does is allow organizations to use large language models, LLMs, and other advanced AI stuff directly on their own private data networks. And this is huge, right? Because it means users can interact with their highly sensitive proprietary data using just natural language prompts. They get accelerated insights securely without ever compromising privacy or data governance. It's a real game changer for secure AI adoption in big companies.
So, okay, when you put all that together, Gotham, Foundry, Apollo, AIP, they're clearly not just another software company off the shelf. They seem to have carved out this formidable position, premier provider of AI-powered data analytics platforms, specifically for high-stakes uses, government, commercial. What makes that so unique competitively? What's their economic moat here? How do they defend that position?
Yeah, it's fascinating how they've built that moat, as you say. It's basically how they keep rivals at bay. It's built on exceptionally high switching costs and these unique intangible assets. For instance, think about their deep entrenchment with U.S. government agencies. That's built over nearly 2 decades now. That creates just incredibly high barriers to entry in that core government niche. It's extremely difficult for other company to just come in and replicate that level of trust, that deep integration. The security clearance is needed, especially within intelligence and defense.
Okay. But the sources we looked at also mention a pretty small overall market share, something like 0.1% in the broad analytics market. How do you square that circle? How can they be both this dominant force and have such a tiny slice of the pie?
Right, and that difference is actually key to understanding Palantir. While they are a tiny player in the huge, fragmented generic analytics market, they are absolutely a dominant force within their specialized, high-security government niche. You have to see the competitive landscape as kind of bifurcated, two separate arenas. For Gotham, particularly inside the intelligence community, there are very, very few direct rivals. Few who can match their specific capabilities, their security credentials, those entrenched relationships. That's a very wide, very deep moat.
Okay, I see. But that's probably not the same for Foundry, right? Their commercial platform. I imagine the competition there is much tougher.
Absolutely. You're spot on. In the commercial space, Foundry faces fierce competition. Really fierce. We're talking about the big, well-capitalized tech giants. Microsoft, Amazon's AWS, Google's GCP, IBM. And then you've got specialized firms, too, like Snowflake and Databricks, who are also very strong. These are innovative companies. They have massive scale, huge sales teams, existing customer ecosystems they can leverage. So, yeah, while Palantir dominates its specialized government niche, its success in the commercial world really hinges on proving it can differentiate itself and use that hard-earned reputation against some of the biggest names in tech. It's a different ballgame.
Okay, let's switch gears to the financials. Because for years, if you followed Palantir, you knew them for one main thing financially.
Yeah.
Massive losses.
Yeah.
There was always this big question mark hanging over them. Could they ever actually turn a profit? Then something really significant happened. A critical inflection point in their story. For many, this was the real aha moment. What exactly changed? What was the magic trick?
You're absolutely right. For a long time, the narrative was just about huge cash burn. I mean, look at 2019. They had a net loss of almost $580 million. $579.6 million to be precise. But then, in a really dramatic shift, Palantir achieved its first full year of GAAP profitability in 2023. They reported a net income of nearly $210 million, $209.8 million. And this wasn't just, a one-off accounting thing. It signaled a genuine new phase of financial maturity for the company. And it gets better, actually. Their cash from operations turned positive way back in 2021, and their free cash flow that reached a really robust $716.6 million in 2023. That's serious cash generation.
Wow. So it's not just profitable on paper according to GAAP rules, but it's actually generating real cash now. That's a monumental shift for a company that was known for bleeding money for so long.
It truly is a huge shift. And it's underpinned by some really exceptional top-line growth, too. Their revenue compounded at an annual rate of, 31.6% from 2019 to 2023. It grew from about $742 million to over $2.2 billion. Plus, their gross margins have expanded nicely, from around 71.6% in 2019 to over 80% more recently. That shows incredible scalability as they grow, And to top it all off, they built this fortress balance sheet, over $3.8 billion in cash and short-term investments. And minimal debt. Their debt-to-equity ratio is tiny, just 0.05.
Okay, so this is more than just good numbers on a spreadsheet. It validates the whole scalability of their business model, right? It shows that powerful operating leverage kicking in. So when you see those figures, the consistent profitability now, the robust cash flow, what's the biggest takeaway for you as an analyst? What does that tell you about the underlying business itself?
It tells me this is fundamentally a high-quality, scalable business model. That's the key takeaway. It's proof that the company can not only grow rapidly, which we knew, but it can also convert that growth into real profits and strong cash generation. It addresses that major concern, maybe the major concern, that many investors had for years and years.
All right, okay. This is where it gets really interesting, though, and where I think the sharp confrontation of ideas really begins for investors. We've established fundamentally strong company, now profitable, generating cash, unique tech, but then what about its stock price? Because the picture changes dramatically when you look at that.
This is precisely the core of the investment dilemma right now. It truly is.
Yeah.
The stock trades at what you can only really describe as extreme valuation multiples. Just extreme. We're talking about a price-to-sales ratio, the PS, that exceeds 100 at times, and a price-to-earnings ratio, PE, deep in the high triple digits. Specifically, the source puts the forward PE at 387.3 times earnings.
Wow. Okay, 387 times forward earnings. That sounds Well, incredibly high. Can you give us some context? Like, how does that compare to other similar companies?
Yeah, let's make it stark. Look at Palantir's enterprise value to next 12 months revenue, that's EV/NTM revenue. It's an astonishing 89.5 times. Now, compare that to the peer median for similar software and data analytics companies, many of which are high growth themselves, remember. Their median is just 9.3 times.
9.3 versus almost 90.
Exactly. Even a recognized high flyer like Snowflake, that's trading around 15.1 times. A tech giant like Microsoft, 11.8 times. So yeah, Palantir's forward PS, its forward PE, pretty much any multiple you look at, it's dramatically higher than virtually any comparable company out there.
That is a staggering difference. It really is. So what does a valuation like that actually mean? What is the market pricing in for Palantir to justify paying such an enormous premium? What are they expecting?
Well, what it tells us is that investors have priced in not just several years of absolutely flawless high-growth execution, but arguably, they've priced in a complete paradigm shift. It implies that the market thinks Palantir isn't just going to be a leading software provider. It implies they think it's going to become a foundational, almost utility-like platform for the entire AI-powered economy, capturing a vast share of the broader enterprise software market with, minimal friction. That's a massive expectation for any company to live up to.
Okay, so that's the market view, the euphoria perhaps. If we try to strip that away and look at its intrinsic value, what does something like a discounted cash flow model, a DCF, suggest? What does that more fundamental analysis tell us about what the company might actually be worth today?
Right. So if you build a robust DCF model, and this involves projecting out their unlevered free cash flows over, say, 10 years, and factoring in assumptions like a relatively high weighted average cost of capital, or WACC, maybe around 11.5%. And that high WACC reflects the market's demanded return for taking on Palantir's inherent risks and its volatility.
Hmm.
That kind of model implies a fair value of approximately $37.85 per share.
$37.85 per share. Okay, hold on. But the current market price is, as you mentioned, well over $150 per share. The market cap implied is $375 billion. That's not just a disconnect. That feels like a chasm. How do you even begin to reconcile those two numbers?
It's a massive disconnect. There's no other way to put it. The DCF strongly suggests this stock is substantially overvalued compared to its current market price. Our synthesized fair value range, which, heavily weights this intrinsic analysis but still acknowledges there's market enthusiasm out there, that range comes out between $40 and $55 per share.
Right. So this really crystallizes the critical question for any investor looking at this, doesn't it? How do you reconcile a company with these undeniable fundamental strengths, this deep moat we talked about, with a stock price that leaves absolutely zero margin for error? This is the ultimate confrontation of ideas for Palantir right now.
Precisely. It's the paradox that defines the investment thesis or lack thereof at this moment.
Okay, so given all this strength we've discussed, the profitability, the cash flow, the unique market position, the tech, why isn't Palantir a buy recommendation in your analysis right now? What are the significant risks that lead you to a hold? What's the biggest red flag waving here?
Without a doubt, the single most acute and significant risk for investors today is the valuation risk. Simple as that. The stock is, as we've said, priced for absolute perfection. That means any perceived slowdown in growth, even a tiny miss on analyst earnings targets, or even slightly conservative guidance from management, any of that could trigger a severe and rapid price correction. That happens as that inflated valuation multiple just contracts sharply. There's simply no room for disappointment baked into the current price.
And what about its behavior in, say, a choppy market? Does its high growth, high multiple nature make it more vulnerable to wider market swings?
Oh, absolutely. That's where its market sensitivity comes in, what we call its beta. Palantir's 5-year beta is approximately 2.59. Now, what that means in practical terms is that for every 1% move in the broader S&P 500 index, Palantir's stock could be expected to move by roughly 2.59% in the same direction.
Wow.
So yeah, during a market correction, you'd likely see much, much steeper declines in Palantir than the broader market. It's inherently a very high volatility investment.
Okay. So beyond valuation and volatility, what other major risks does it face? Particularly thinking about its growth areas.
Well, intense competition is definitely a major one, especially for its commercial foundry platform. Those big, well-capitalized tech giants we talked about earlier, Microsoft, AWS, Google, they're not standing still. They could develop good enough integrated solutions within their existing ecosystems or just leverage their massive customer relationships to blunt Foundry's growth potential. That's a real threat. There's also customer concentration risk. A substantial chunk of their revenue, particularly on the government side, comes from a relatively small number of very large long-term contracts. Losing even one of those major contracts could have a really material adverse effect on their financial results.
And given its origins working with intelligence and defense, it must face a unique set of reputational risks too, right? Headline risks.
Indeed, it does. That's a constant factor. The controversial nature of some of its work, particularly with certain government and law enforcement agencies like immigration and customs enforcement. ICE, for example, leads to persistent public scrutiny, negative media coverage. And that can have knock-on effects. It can make it harder to attract top tech talent, especially younger talent who often prioritize social impact. It can also make some potential commercial customers hesitant to partner with them. You see this reflected somewhat in its low social ESG score and its very low data disclosure ratings from some agencies. Beyond that, you've got other risks too. Shifts in government spending priorities could impact them, and just the rapid, unpredictable pace of technological change in AI itself is a constant threat they need to navigate.
Okay, so wrapping this all up, what does this mean for you, the listener, looking at this stock? If it's a great company, fundamentally strong, but with what we've clearly identified as a very risky price tag, what's the prudent path forward for your portfolio? What's the advice?
Well, our analysis really synthesizes to a pretty clear conclusion, I think. Palantir is undeniably an exceptional company. It really is. It boasts a superior technological platform, undeniable fundamental quality, has turned the corner on profitability, and it's benefiting from these powerful secular trends in AI that are only accelerating. That's all true, however, and it's a big however. The investment case right now is severely challenged by the stock's extreme valuation. The current price reflects, frankly, a euphoric level of optimism. And as we've discussed, it leaves just a razor-thin margin of safety for anyone buying in today.
So that leads directly to the whole eye recommendation then. Why not a buy if the company's so strong fundamentally? But also, why not a sell if the valuation looks so stretched?
Right. A BUY is simply unwarranted at these levels because of that excessive valuation risk. The potential downside from a valuation resets if sentiment shifts is just too high right now, but a sell feels premature too. And here's why. The company is benefiting hugely from these powerful secular tailwinds in AI. It does possess strong business momentum right now, and that momentum could allow the stock to remain, let's say, overvalued for quite an extended period, especially if they continue to execute flawlessly quarter after quarter. So hold becomes the most prudent course in our view. It reflects both the company's underlying strength and the stock's very real, very present risk.
And what about specific advice for investors who might already own Palantir shares versus those who are thinking about maybe getting in now?
Yeah, good distinction. For those who currently hold shares, our analysis suggests it might be wise to perhaps trim your position on strength. Yeah. Maybe take some profits off the table given the run-up, but probably not exit entirely, given the company's genuine long-term potential and those strong tailwinds it has. For new investors, though, people considering buying now, the recommendation is quite clear. Remain on the sidelines for now. Wait for a significant pullback, something on the order of, say, 25% to 30%, maybe even more. That kind of drop would create a much more compelling entry point, one with a significantly greater margin of safety. Patience is really the key virtue here, I think.
Right. And that wraps up our deep dive into Palantir. It really is a fascinating case study, isn't it? A truly innovative company wrestling with these intense, sometimes maybe irrational expectations of the market. What stands out to you as the single biggest takeaway from our whole discussion today?
For me, it's ultimately understanding that crucial difference between a great company and a great investment price. They're not always the same thing. Palantir's story is definitely still unfolding. Massive potential, no doubt, but its current valuation, it just demands extremely careful consideration from any investor thinking about putting money to work right now.
Indeed. Wise words. And for you, the listener, maybe here's something to mull over as we finish. Could Palantir's controversial nature, the very thing that draws criticism, could that actually be its secret weapon? Could it inadvertently weed out competitors who just can't stomach the high-stakes, ethically complex work they do? Or is it more like a ticking time bomb for its social license to operate? Something that could potentially limit its long-term growth avenues? Definitely something to think about. Now, if you found this deep dive valuable, imagine having this kind of clear, in-depth analysis on the topics that matter most to you, delivered straight to your ears regularly. Don't miss out on more insights like these. Subscribe now wherever you get your podcasts for the fastest and most frequent updates. Let us help you stay well informed.